All right, hey, welcome to the Hurley Investments Financial Services Commentary. It's just a midweek chat. It's a chance for me to share what I'm thinking as I stumble through this, share with you what my thought process is. Today is Tuesday, the 17th of January in 2017. I'm back. I'm back to being able to do these every week for you. I am a registered investment advisor, so what I like to do is spend some time with you on what I see, why I'm doing things, and then make sure I leave the last 20 minutes, 15 minutes available for you to ask questions about whatever you'd like. But again, this is my first one. I've been back since last year. Last year in summer, I just had some things come up towards the end of summer, and I just got busy. But I'm glad to be with you. It's been a while since I've spoken to George. Roy, I spoke to you yesterday. Marv, it's been quite a while since I last spoke with you as well. Mike, nice to have you here. Octavio, nice to have you here. Vlad, I don't know if I've spoken to you before, but I'm glad you're here. Jim Woods is here. Let's get started. As I've talked to some people here in the last little while, one of the big things I had, especially since last year, what are my choices in the stock market? Because everything I look at seems to be the same, and now it's 2017. I started getting this question back in November of last year. So out of curiosity, for people that were looking to do something different or ask, you know what, let's do this in two different things. What do you think my response was to people in regards to what I was doing? What do you think my response was to people in regards to what I'm doing? And if you don't know, I am primarily a collar trader. But we had some stocks last year like Visa that just didn't move, that Disney that was down, Apple was down for the year, Baidu was down big for the year. What do you think my answer is when I start getting a question about, hey, are you going to do the same thing you did last year? What do you think my answer is? Collar trade, yes. What do you, there you go. Of course I'm going to do the same thing. Uh, I look a lot better this month in a flat market than I did towards the end of last year. And unfortunately, last year, I'll be the first one to tell you, I somewhat overprotected. We had 4 rate hikes that were supposed to happen. We had pigs at the beginning of the year, the oil mess, Brexit. Yes, I made sure we were protected on everything. It's what I do. I want my people to sleep at night. How do I look so good at the beginning of this year? Well, a couple things have come back a little bit. But when you add 100 or 200 shares to Disney or to Baidu, maybe if it's even to Apple or what's the one I'm trying to think of, Visa, a little movement goes a long way. With that said, of course I'm going to do the same thing because I have experience and know how well it works. Really, there is no better way. There is no better way to create wealth than by picking up shares as stocks fall in value. Last year was a bit of an anomaly. Okay, so I spent too much money on protection. With that said, I also got to pick up some shares. And because I picked up some shares, I'm looking pretty smart right now. Really, if Disney got back up to 120, I could almost make my portfolio on the year on that. If Baidu got back up to 200, I'd make my portfolio for the year would be made on it. I have experience doing this, and I'm kind of shocked to hear people that do this kind of trading or this kind of trading or this kind of trading And the moment things get a little ugly, they start doing something else, which lets me know they haven't spent enough time doing their research and understanding what's happening to the stock market and why. Their system that they would swear to me last June was so good, it's all they ever do, they did it always, yet in November they're looking to change what they're doing. It's not a system that's repeatable. It's not a system that works under any market condition. It's not a system that you can create wealth. It's not a system that they have enough experience using. Know what you understand, know what you do, and work on it. Some people at the beginning of the year, my suggestion might be spend some more time studying. Spend some time understanding what's happening and what your system's going to be. Good question. Questions came in. Kevin, off earnings, how often or how much do you leave your stocks unprotected? As in without earnings time. So here's how I normally am doing it. When I have my earnings, and let's look at caller trades, and again, this changes all the time, but my basic caller trade structure is you buy to open stock, right? And I'm just going to use some relative numbers. At 100, I am buying to open at the money, long puts, and I am selling to open, hopefully 3 to 4 strikes higher, short calls. Those long puts, I'm trying to get out roughly 60 days after earnings. My range is between 45 and 75 days. That is the range on where I want those long puts to be. My short calls, I'm usually going to be out there 45 to 90 days. This is my basic position to get in for new money or a new position. My thought process, I want less than 3.5% total invested capital risk for the earnings play. And I don't like to cap the upside. With that said, if we have really bad earnings, the first thing I do is I run out to a leap short call for a huge credit. And what I define by really bad, a complete miss on top and bottom of the earnings. I'm looking for a management change, a miss on a product. On a huge earning, I want to do a short call for a huge credit because I want a negative delta effect. I want to make sure that I'm going to make more money on the way down, and on the way down, I'm looking to adjust the covered call or the short call and the long put around a support level. Willing to add long puts again immediately if support doesn't hold. And more often than not, support doesn't hold. But the key here is trading's a process. And And when you understand it's a process, the neat thing is you get just as excited to see stocks fall as you do to see them go up. Abraham, set of strikes in percentage terms, how much higher for the short call? I don't know, Abraham. Whatever it takes for me to get down to a 3.5% or less initial run in the trade. Sometimes it might be 2 strikes. Sometimes it's 3. Sometimes it's 4. It depends if I'm going to go out 45 or 90 days. The neat thing is the rules that you have need to be flexible for market conditions. So the short answer is I literally do the best I can. And Vlad says, yeah, but sometimes you run out of leap short calls. Thanks, Abraham. To rule out your put protection farther out? Correct. At that point, the short answer, if you have a leap short call and your stock's been probably going higher, Vlad, is that what I'm going to assume? That the stocks are going higher? Vlad, what do you think? Is the stock going higher so you run out of credit, or the stock's going down? So Vlad, help me better understand. Both higher. Okay, so here's the thing. If it's going lower, you can cash in that leap short call for a profit. Boom, you're off to the races, you cash it in. If it's going higher, you might be stuck with a leap short call that costs you a bunch of money to buy back. For example, on NVIDIA last year, got caught with my pants down. The thing went from 40 up to 48. Boy, it was ridiculous to buy it back. Hindsight, should have spent the money. Instead, we're getting about a 300% return. It's like selling the stock at 62.50 now. I've got it at like 42, and I've got some $20 credit. I'm in it. I'm sitting in it. I'm going to stay in it. It's where it's going to be, and for all intents and purposes, I can be very cheap because my delta is sitting at like a 0.94. I can go way out of the money and spend 45 cents on protection for NVIDIA and have a negative delta. So Vlad, in all honesty, because I want to get a bigger return, I'm not always having my short call pay for my long puts. In fact, when I initially start, I still have 3.5% of risk. So as I'm starting collar trades, I rarely, if ever, go right out to leaps. If I've got someone that says I don't want to ever lose a penny, well then I'll go out to leaps. But for a leap, you have to wait an awful long time to realize your profit, and I'm okay with taking a little bit of risk to get a pretty good reward. If I've got my risk down to 3.5%, that means I don't like to cap the upside, and I'm looking for 4 rewards per 1 risk. So whenever I initially place, a collar trade, if I've got $2,500 at risk, I'm looking to be able to make about 10 grand. And that really comes down to the fact that I get pressure from people to perform. I get pressure from people I always have to have a return every single month. And I scratch my head and I go, well, if you're looking for a return every single month, I don't think you're going to find it, because the market's going to give you something that you just don't make money every single month. That things don't work out. Now, over a period of time, boy, you can add shares, and when you least expect it, and I'm going to say in January, I might have some of my clients up just with Disney alone over 10% for the year on a market that might be down here in January. In fact, if I can go ahead and I can skip to it, I'm going to go to a poll question. I'm going to launch a poll question for you. Where will the SPX, that's the S&P 500, where will the S&P 500 finish January 2017? Right now we're at 2267. So I've picked a couple spots. Go ahead and click on that. You should have a sheet that opens up to you, a poll question. Go ahead and click, where do you think the S&P is going to end January? Will it be at 2285, about 18 points higher than it is now? Will it be at 2265, a support level, kind of where it's sitting at right now? We're going to get up to that 2300, which means the Dow is going to break 20,000. All righty, I'm going to go ahead and I'm going to close this down for you. Very interesting. I'm going to go ahead and share this with you. One person said 2300, two said 2285, one said 2265, where we are now. One said 2250, one said 2225 or lower, and that's where my vote would go. My vote would probably go from 2250 or lower. And that really comes down to the last couple of years and how it got hit by January. But more importantly, so I can go ahead and, oops, might as well go ahead and fix this one. My vote is I'd expect us to be down about 5%. And the reason why comes down to nothing more than we don't have a whole lot that's happening for earnings this week. We're on the second week of our bank stocks before we run into a true earnings season with Alcoa going. We have a pretty big Wednesday, Thursday, and then options expiration for January on Friday. But we have a couple big economic reports. We have the ECB. We have, what is this thing? I thought I had some of that done. Get rid of that too. We had the ECB on Thursday. We have China's GDP, industrial production, retail sales, normally down pretty significantly after Christmas, and it doesn't quite pick up for their New Year's celebration or their 10-day celebration, the week-long celebration. That usually happens in February. We have the U.S. presidential inauguration on Friday. So the short answer is usually we get a bit of a sell-off in January. If someone were to ask me what's my expectation or how will the week end or what's happening this week and why, we're pretty much in a holding pattern until China numbers on Thursday, then a presidential Trump in on Friday. What economic value or what fundamental does Trump have getting in on Friday? Absolutely none. Hasn't done anything. Nothing's going on. Where our weekend this week? I don't have a clue. I wouldn't even try to guess. We just have had 8% run up, Sagas down to 7%, 7% run up since the election on hope. Not a fundamental. Some of the things that he could do might be very interesting and very good for the country. None of it's proven yet. None of it is expected. We'll have to see. I'm not sure where we're going yet. With that said, I can take a look at the Dow, and even though we've had crossovers, I kind of have too big of a chart here for you guys, don't I? Let's shrink my chart down just a little bit. And let's change my view. It is to a web layout. All right. We do have our crossover on the MACD, but everywhere else we're still bullish, so we are still technically bullish. But consolidated. Been going sideways for over a month now. God, we have a quadruple, maybe 5 times. Couldn't break it, couldn't break it, couldn't break it, couldn't break it. 5 times it literally made a run, maybe 6 if you want to go daily. But we can't seem to break the 20,000 mark. Why is that? Well, at 20,000, we have a lot of funds that have sell positions set up to book a return. Probably it's going to match that Elliott wave or Fibonacci number, that's 16.66%. Had a run up from that point over the last year and a bit. There are going to be some profit taking in that 20,000. And what you see, a consolidation pattern like you see right now, are all those sell orders stacked up at that 20,000 and all those buy orders stacked up between 19,800 and 19,700. We're just wiggling through that. I unfortunately think because of last year and the surprise return last year, we probably have more of a bias to the downside than we do to the upside. So my expectation as I look at least the Dow, probably heading down lower. Probably heading down lower, kind of standard for January. If you look at the S&P 500, same thing. Technically bullish. We have the MACD indicator that's crossed bearish. But we can't seem to break that 2,300 level. Rather unique, not just to see it on 30 stocks like the Dow, but to see it on, what, 509 or 507 stocks on the S&P? And it has a bigger range to the downside. There are not a lot of people looking to buy at that 2,200 level, 2,240. All that occurred in this time frame and in this time frame. On the flip side, NASDAQ, technically bullish, but this looks like a better bullish chart to the upside, right? It's a ladder chart. We've had our breakout. Hopefully Apple won't destroy it, right? Bullish with a stair-step pattern. Runs up, little pullback, runs up, little pullback. I really like technology right now better than the S&P 500 or than the Dow. With that said, when people ask how am I looking to trade, I'm basically collared with Disney, Netflix, and Baidu would be my big upside surprise stocks. Let me take that back. I'd like to throw one more in there. I could see Ford being it. So I'm basically collared, getting ready for earnings. I do have my chart. So if I was looking at earnings, I've created my earnings chart already. I have not updated it yet today, but my basic earnings chart tells me that Apple is 0131 after the market closes. Alibaba is 0124 before the market opens. And I just have these written down in a folder. Bank of America was 0113 before the market opened, and they beat on earnings but missed on guidance. Baidu is 0223, and it is estimated. It does not have a set time yet. Citigroup is on the 18th tomorrow before the market opens. We have Disney that is on 0207, and that was estimated. We have Ford on 0126, and that was estimated. We have Facebook that is on 0201 after the market closes. We have Nvidia on 0215, and that is an estimated date. We have American Outfitters, it's the old Smith & Wesson on 03 of 02, and that is estimated. We have Visa on 02 of 02 after the market closes. We have Zions Bank Corp on 0123 after the market closes. We have D.H. Horton, the home builder, on 0124 before the market opens. And the XLE and the XLRE do not. These are a couple of ETFs that I use. And these are non-earnings ETFs. So right now, that's basically my, that is my basic except for Netflix. That is my basic portfolio looking right there. So here we go. Questions to you guys. And it looks like I've missed a couple, so let me play a little catch up here. Terms of time, 10% or more, do you leave unprotected? Oh, sorry, lad, you started that question, never finished it. So more often than not, if the stock goes up, I'm going to be leaving it unprotected. In fact, I will short puts against my long put to see if I can't completely pay it off. So I might have a long put there that I've nullified with a short put, in which case I'm leaving stock unprotected for the whole next 3 months until I run through earnings. Same thing if the stock goes sideways. If the stock runs down, I'm usually looking for a pretty strong support level and a couple-day confirmation to cash in my puts, knowing I might reprotect it. I don't necessarily have a set amount of time, but usually I'm trying to stay out of protection for a couple weeks on a run-up before earnings. Has it stung me in the past? Yes, I have been stung big time by SanDisk. SanDisk dropped $13 overnight, 3.5 weeks before earnings. Killed me. It really was a booger. It just killed me. With that said, I do what I do, and it's kind of neat because I've got some bigger money coming over to me, and I guess I enjoy where I'm at. I enjoy seeing the way portfolios will grow, but it's a process, and that's the key, is trade your process to success. Could I have done a better job last year? Probably. There are some things I probably overprotected. The job that I could have done better um, was last year, a rather unusual year. Would I have done things different? Excuse me. Probably not. With all the risks that we have, with how far out in time we are to having a pullback, no. I probably, if I had to do it all over again, I'd probably do it the same way I did, considering I didn't know how our year was going to end. Most of our gains came basically at the end of the year with a Trump run up. And to be all honest, I really enjoyed some of the moves I did with Disney. For some of the bigger accounts, the $1 million or more, we added a couple hundred shares of Disney, a couple hundred shares of Baidu, added a couple hundred shares of Apple. About the only thing I wasn't able to add shares to was Visa. On my medium group, couple, 100 shares of Disney, 100 shares of Baidu, and I still have some cash. I am looking to put some cash to work coming up to this earnings event. In fact, I'm holding off for the most part until Friday so I can run into next month and take full advantage of some March or some April options. And money is going to be going to work starting as early as next Monday for the most part. Next Monday is when I'm going to be looking through accounts, seeing where I have cash, seeing where I have some opportunities, and seeing what I can do to move some stuff around and make some money. So guys, what questions do you have for me? What questions do you guys have for me that I can get answered for you? All right. So the XLE, kind of interesting. It's probably the XLF, isn't it? Although they changed it, I thought. Give me a quick second. Let's make sure I'm telling you what I think I'm telling you. Last year, the financial ETF, the XLF, was split, I believe. And it is the XLF. It's split to the XLRE. So, who is that? That's Abraham. Thank you, Abraham. The XLF, all I've been doing is putting a longer term covered call, a leap covered call, and letting it go, also collecting a pretty nice covered call credit and some dividends, couple percentage points of dividends. That's all I'm doing on the XLF. It helps for small money that's in. It worked out quite nicely last year, came in with like a 6.7% return. It's not one that I'm spend a lot of time managing. It's just one to put some money in that gives some people some percentage returns, and it's helping people taking some dividend credits. It should be the next group that makes a big run higher. So this year, I'm up, gall, I think I've got about a 12% return, so it's probably three strike prices higher, going what, to 27 or 26 or 27? It's got to be probably 27 on the covered call, looking for a 12% return, including the 2% dividend, or roughly 2% dividend. I don't have the numbers right here in front of me. The XLRE is the real estate side. This was pulled out through a split last year. It is the real estate that banks own and are earning, or financials are sitting in, since some of their areas are kind of expensive, so to say, and not bad. So it's a kind of a nice little unique ETF there as well. What do you think of KRE or KRB regional banks? My regional bank is Zion. I don't think much of those two at all. Zion has been my regional bank, and it's been my big winner over the last couple of years. Regional banks have quite a bit of risk in them. And when they have quite a bit of risk in them, I usually want to stay away because they seem to be run by headline risk, regulatory risk. As you can see, just for the last 6 months, from 23 up to 41, that's a kind of movement I've enjoyed in Zion's. It's a Zion's bank in my area. It's one that I know. I know a couple of the VPs, and at one time it traded over $100 pre-2008. So Zion's is my regional bank that I am going to play the regionals on, because I know it better than a KRE or a KRB. With that said, looking at a KRE, I might say, well, there's a run. There is a great run. Had the same run that that Zion's had, maybe even a little, well, not quite the pop, but the same chart movement. And KVRVL probably. The short answer is, why am I sticking with Zions as well? Because they can have those big movements up or down based on earnings. And over time, I've amassed quite a few thousand shares of Zions Bank, whereas on an indexed ETF, um, they they usually don't have those same pops or those same moves. But I like the chart. I did the chart. Looks very similar to my stock. Very similar chart pattern. I maybe paid 20% less, but it looks like we've got about the same percentage return. So, in all honesty, this has worked just as well. Timing might be a little bit harder to time it just on crossovers versus preparing for an earnings event. But Ida, there's no reason why KRE wouldn't be a great regional banking ETF. I would have been disappointed because I would have set up a leap short call and left it alone. And obviously it made over 10% last year, which is, it's kind of nice, right? Nice to see 25% of your portfolio, if you're just in callers, make over a 20% return for the year. Nice to see a 5% return on one stock out of 4 or 5 in your portfolio. And really, that's kind of what did it last year. I missed an opportunity for some people to be in Netflix. It really didn't show a fundamentally sound time frame. So people that had got into Netflix the year before, primarily in the April and the July, August months, Netflix made my medium group that $250,000 to $500,000 range. If you're in with me back in 2015, that group did really well because of Netflix. Those that were not with me at that time period that joined after that, we're still waiting for those Disneys to move or for Visa to move even farther. Any other comments or questions you'd like to go over, guys? So you know, I will be posting these on, it goes on myhurleyinvestment.com. So it's myhurleyinvestment.com. I will do the best I can to post the notes and the video. So if people want to go over them, they can find them on myhurleyinvestment.com. Midweek commentary, be able to click on it and at least get the notes off of it, if not the video. Any other questions? Or Abraham, anything else you saw that I did not spell correctly? Abraham, yes, I usually try to post the word archive below a video. SanDisk did become Western Digital. In fact, Western Digital finally moved, I thought, the last earnings. But yes, SanDisk shares became Western Digital. I was out previously, and finally you saw some movement from 23 up to 32. And I want to tell you that was an earnings event, but you finally saw the movement. I wasn't willing to sit through the time. In fact, I got disheartened and disenchanted with SanDisk when they announced 3.5 weeks early, not within that typical time frame, that they were not going to meet numbers. Roy, fundamental. What are the fundamental criteria that you look for potential collar trade? Roy, that goes back to level 1 for safe option strategies. For you, that might be an options animal there, but really, I've got a checklist of 15 different things I'm looking fundamentally to make sure the stock is fundamentally sound. You do not want to collar a stock that's going to go out of business, although you can be profitable. And you're looking for movement. A chart like this would actually show you a pretty good collar trade opportunity. Anytime you see these 20% movements where you're going from 22 up to 28, 28 down to 24, 23 and a half, 23 and a half up, you're looking for movements. You're looking for good movement on the stock. With that said, I'm doing a pretty interesting, I might be doing some more of these that are going to be more of a, well, heck, there might be a chance that Options House and E-Trade wants me to start to talk to some of their people. So if a stock is fundamentally sound, I'm looking for significant movement. That could come from Western Digital. It could come from a stock like Disney. Now, something to keep in mind. These runs down from 122 that went down to 84 occurred over a 3-month period. 84 up to 98 happened over a couple-month period. 98 to 105. 105, I caught it down at 95. 92 up to 100. It's these kind of movements that I'm looking for, but understand these movements occur over a year and a month period of time. This is not month-to-month trading. This is quarter-to-quarter trading. And in all honesty, Disney has a couple gaps here that are somewhat unexplainable, that you're not really looking for them. Probably an earnings gap, probably an earnings gap, little gap there, kind of unexplainable. Gap to the upside, kind of unexplainable. But it's movement. You're looking for movement. Disney is a great stock to pick up a couple hundred shares last year and have the movement be to your side. Netflix, good movement. I looked horrible. In fact, I was taking quite a beating in people's portfolios on Netflix up to October. We had done nothing but add a couple hundred shares, run up, add 100 shares. I had to add shares twice, but the gap here was a little unexpected. Um, so literally, I looked like a doofus for this 3.5 month period. And then we got the pop, and all of a sudden I looked like a genius. Losing a little bit of money, losing a little bit of money, losing like a little bit of money. Kevin's an idiot. Oh no. A year later, I'm a genius. A year later, oh my gosh, it made my year. Um, it's just following the process of collar trading, and it's much easier to explain and to show over a year's period of time than a month or two or three. If a good collar trade candidate, and if yes, why? So I think I've got Ida and Roy, I think I've got your questions answered there. Fundamentally sound, not going to go out of business, and movements in the stock positions. It's kind of nice to see stocks that are paying dividends. One of my surprise stocks that I did not collar, that is one that I feel I missed last year. Who would have thought a stock that has a good dividend like a General Electric could have been a good collar trading stock last year? Really doesn't make a whole lot of sense. It's not supposed to move like this. It's not supposed to have 20% movements. It's a blue chip. Visa, kind of a safer stock. Not really a great stock except for last year we went through this movement or this movement would have been your chances to pick up some money. The movement in June is the one where if I did have the opportunity, I added my shares right there. Obviously, you would have added shares here, but didn't quite move them enough. You're typically looking for a 20% movement in the position. Ford is a great collar trading stock if it'll ever break 13. Ford has been under 13 for quite a while. But great big movements, 13 down to 10 and a half, 20%, run back up 20%. It would have been really hard to trade Ford, and it was going through this time frame. But you know 13 is a top out, even an out of the money, 13 down to 11, 10%. 12 and a half down to 10, 10%. You do have some opportunities, excuse me, that's closer to 20%. You do have some opportunities with Ford, and it is a cheaper stock. A really good stock last year, believe it or not, to trade. And I worked with some people on this before. Pandora. $14 down to 10. There's almost a 30% move. You had it 15 down to 7. Opportunity to double your share count. 11 and a half down to 8. There's another opportunity to pick up 20% more shares. Pandora, other than obviously June through October, kind of ugly, but the October through November, probably would have had it protected up at 15. $11 would have been a technical crossover or a chance to take a shot at it right there. All right, guys. Hey, I appreciate you being here. Nice to have you guys back. Vlad, Kevin, what's your opinion about the collar trading on Forex with Forex options? Higher volatility, more frequent reopens, but the market is overall moving sideways. I would not be trading the Forex in general. The Forex is a day trading mentality. You are correct that it is moving sideways and it has a pretty defined range, but you're trying to guess news. You're trying to see the value of the gold and the silver. It's trying to predict the strength of the dollar against the yen or the Japanese currencies. I don't like to trade news. News is not predictable for me like an earnings event. Same reason I stopped trading commodities. I just can't see on commodities how you're going to trade the weather. The weather is the big mover for commodities. So for those reasons, I would stick with the collar trade on options, or in general, I would stick with something a little bit slower moving than the futures, than the Forex, than commodities. I mean, in my opinion, it's just gambling. You really can't predict news-driven equities to trade. And all the people, I mean, I've seen it. I've seen well, they do this, they do that. You do this, you do that. I just haven't seen 2 years of profitability shown to me by anyone. And that's after going to the money show. Vlad, it's true for the caller, you don't need to predict, except I like the advantage I feel I have that I can protect through an earnings event. That I say, hey, here's the earnings. We're off to the races. We're good to go. It's predictable when to expect my moves up or down. For the caller, you can't always stay protected, in my opinion, and have a profit because it costs you about 16% to 20% to have those long puts in place. If you're always protected, you need a 20% movement to gain value or profits. And that's just tough. It's easier to do on a known event, and then you can play it through what is typical a trend from that period on. For myself, when I used to trade Forex, I got really frustrated. I got really frustrated that my trend would change so quickly, and it did. It did because it was day trading. I personally, I guess, I never had good success on the futures or the Forex markets, and the reason why for me was I just missed the trend. All right, hey, nice to see you guys again. Abraham, thank you very much. I will see you again next week, same time, same bat channel. If you miss it, that'll be okay. I will try to do a better job and a good job of posting everything online for you so you can pick it up online and you'll be good to go. Thanks for being here. I'm glad to have you. For those that are rather new to me, welcome to the chat sessions. You can bring real trades, since I am licensed, bonded, and insured. You can bring some real trades to talk in this section if you would like. Hey, here's where I'm at. Here's my cost basis. We can talk adjustments, and we'll go from there. You guys have a wonderful evening. Look forward to seeing you next week. Take care, and until then, trade safely. Bye-bye, everyone.